Hey guys, what's going on? It's me, Rags Riches. It's been some time since we had last connected. I've been a very busy bee. This past year, I've done a lot of deals, done some personal development. New year, new me, so I've been hitting the gym a lot. But of course, I'm still in the investment game. We've continued to scale up the portfolio, which I'm going to be speaking with you guys about in the near term. But today, I wanted to actually address something which I've been personally looking for content on social media for, and I literally could not find anything. And that's related to the world of alternatives that non accredited investors could invest in. As you guys know, there is a high concentration within the S&P 500 and other index funds. A lot of people who are in the millennial and Gen Z cohort are looking to be getting invested in things outside of their retirement account, trying to save for their future and long-term goals. And typically that's done by a combination of, say, stocks and bonds and some other assets that they buy. Perhaps they put money into a savings account, but that's not what the wealthy are doing. Instead, wealthy investors typically have a much higher than average allocation to alternative investments, and generally speaking, that could expand from venture capital to private equity, increasingly private credit to cryptocurrency and infrastructure. The challenge is that for people like, say, yourself and I, we wouldn't have access to the top tier funds that would be allocated or given to you as a client of a private bank or asset manager firm. In good news, there are a number of options that are available today for people to get invested in venture capital, one of which, as you can see on the screen, is called the Cashmere Fund. Now, for those who don't know, the Cashmere Fund is what's known as an interval fund that was launched a couple years ago as an early stage tech type of startup that's been taken over by new management and has some really cool, interesting assets that you can hold. To explain it in more detail, let's actually review the website to just go through what's going on here. From the direct website themselves, we invest in companies that move culture. Cashmere gives everyone access to high growth potential early stage pre-IPO private companies backed by cultural taste makers, iconic founders, and top tier VCs. Invest in under 5 minutes with as little as $500. Now, just to speak towards some of their holdings, they have $7.5 billion of value in their portfolio companies. They've raised $1 billion, or the portfolio companies have already raised $1 billion, and they have 5,000 plus investors to date. And as you can see here, they have a number of portfolio companies. These include Mr. Beast, Ganas Ventures, Graza, that all oil company you see on all the social media channels, After, IQ Bar, Nada, Parallel, Feet. The Cashmere Fund spans a number of industries, 7 to be specific, across 33 companies. And out of the portfolio companies, they have 100 years of experience working with startups and brand partners and ventures. Now, the fund is currently being managed by a number of partners. Many of these people you may know on the screen. You got Josh Allen. He is the 2024 NFL MVP, 3-time Pro Bowl selection. You got Lena Lyon. She's another partner. You have Eric Wood, Damar Hamilton, and you may not actually know the last two names, but in short, one of the focal points of the Cashmere Fund is that they're not actually targeting assets or money or contributions from, say, your typical high net worth or ultra high net worth investor. Instead, their whole idea is the power of influence, meaning they'll take very well-known celebrities like Josh Allen or partners in the private investment space like Jenna Lyons or Eric Wood and Damar Hamlin, who are college athletes or professional athletes, to bring in their social networks to bring attention to the underlying portfolio companies, potentially increasing sales, valuations, and then there's a flywheel effect, whereas more people become involved, more people speak about it, and then that increases the value of the investments overall for more people, allowing those companies to do really cool things. So I think it takes a bit of a unique spin on the allocation or capital raising process compared to many venture capital funds. Now, they do have a sponsor or people that are being sponsored as well. You have some college athletes here that are pretty active and vocal on their social media channels for promoting the platform. And then there are a number of co-investors like Richard Branson, Mark Cuban, Ron Buckley, Andrew Horowitz, Google Ventures, Y Combinator, 500 Global, American Express Ventures, and so on and so forth. Now, to get into like why you might want to allocate capital to something like venture capital, there's a number of things that we have to cover first. Firstly, obviously you should connect with an investment advisor to think about your long-term goals and risk objectives. I'm not a financial advisor, so I can't tell you what to invest in, what you should invest in, what you should not invest in. These are ultimately personal decisions, which you need to do a level of research and understanding about where you are today and where you want to go to make sure that what you're putting your money into is going to get you from here to there in the most effective and least risky way possible. But for many institutional investors, for the longest period of time, venture capital has been one means or method to actually allocate capital to some of the earliest stage companies with the potential of having a long-term return. I'm going to go over to JP Morgan's website here, as I think they have a really good article that explains their thought process on it. What is venture capital? Well, venture capital provides financing to startups working on novel technologies and innovations with a high potential to create value. If you think about it, many of the largest companies that we are using on a day-to-day basis were at some point just an idea. Think of Facebook, think of Google, think about Amazon, some of these really large tech companies that make up a large portion of our economy today at some point were just an idea, such as Apple with some guy in his garage, right? Now, how venture capital works is that people can create and provide value and capital to early stage companies to allow them to have the funds needed to get their idea off of the ground. But doing so is going to come with a high risk of failure. Typically, when you're investing in venture capital, you're going to be taking a form of equity position in the company or a future claim on equity, such as convertible debt, which then allows those underlying capital firms to receive a share of the business. Now, venture capital comes in a number of shapes and sizes. We'll just be speaking on the format and structure that the sweater Cashmere fund is, but these, can range from limited partnerships to direct investments to convertible debt offerings, a number of ways to get exposure to the asset class. Now, typically from an investor perspective, when you're trying to get out of the position, there's a few ways where that can take place. Either the company gets big enough where it can do a traditional series round, where more institutional players will allocate capital to buy the existing holdings of shareholders. That might be the business owner, that might be a venture capital fund, that may be a bank as an example. And over time, those companies, if they do successful, will either raise sufficient money to be taken out by a private equity firm. They'll go public, where they'll raise money from the public to allow early stage investors to exit their position, or they just may stay private forever. It really depends on the underlying company. Now, the role of venture capital is really important because when you're thinking about starting a company, you need money, and you may have a couple, 10, 100 millions of dollars, but if you're really trying to scale a business rapidly, you're going to need capital for employees, capital expenditures, research and development, and a number of items like that. And many people may tap their friends and family to get the money needed to start a company, but typically if it's a really good idea, you may instead want to go to a venture capital firm, such as the Cashmere Fund as an example, to get capital to expand and grow your business. Now, with that being said, a lot of risk involved with investing in an early stage company. It's not like you're investing in Hormel Foods or Apple or Google, which are mature companies with defined cash flows. At the end of the day, venture capital is simply and solely just ideas. So what do you do if you want to allocate to these types of assets? What is the return that you're going to get for the level of risk that you're taking on? I want to bring you to this website here, venturecapitalai.com. I found this article to be insightful because it had some historical price information about how venture capital has performed as an industry over time. Take you to figure 1 here, U.S. private equity and venture capital index returns. Now, if you look at the index here on a 5-year basis, at least for the index that they had constructed, there's a 15.4% annualized rate of return, 14.8 for 15, 14.3 for a 25-year term. And obviously, past performance does not indicate future returns, but that can give you a sense as to the type of returns that people have historically seen from venture capital. And let's compare these longer-term time horizons to some public market comparables, right? Over 5 years, venture capital has outperformed the S&P 500. 15 years, it has not. And over a 25 period, It has. The same would apply for the NASDAQ, the Russell 2000, many other indices as well. Because you're early in the investment cycle of these companies, there is a higher potential for long-term returns because as those companies grow and expand and develop, you would be on the ground stage of the work that they're doing, which is a pretty cool and powerful thing. Obviously, there's some other information on that, but just to call your attention onto the potential for returns here. Now, I want to bring you guys to investor.gov because private assets come in a number of shapes and sizes, but for many people that aren't accredited, that won't be working with a financial advisor or a wealth advisory firm or the funds themselves, they may not qualify for what would traditionally be how you access these assets, meaning a direct investment with a check written to a founder or under a traditional fund structure where there's a general partner and you're investing in limited partnership interests within a portfolio of private companies. This Cashmere fund and a few others which are increasingly launching in this manner are what are known as interval funds. And interval funds are a type of investment company that periodically offers to existing shareholders the ability to sell their shares back to the fund. That can range from 5 to 25% of the fund at any given interval. Those intervals can be set by the fund manager via their prospectus on a quarterly, semi-annual, or annual basis. But because there is that liquidity that the interval fund structure allows for shareholders to have, rather than many of the public markets like ETFs or mutual funds or closed-end funds that typically do not hold alternative or illiquid assets, this fund structure allows the fund, in this case the Cashmere fund, to invest in these types of things which you couldn't typically get. And why that's powerful is because you don't necessarily need to be accredited to invest in an interval fund. Many of these types of structures have low minimums of $1,000, $5,000, $10,000, or $25,000 compared to the massive checks you need to write for a traditional private equity or venture capital fund of $1, $5, $25, or $100 million, which is a really big bite size for most people. Now, to go back to the Cashmere fund, I want to take you to their portal here. Obviously, you can go to app.sweaterventures.com to hear a bit more about how their platform and their fund works. But to give you some examples, they got their prospectus here, which I would highly recommend you reading. Portfolios here as well. They have their contact information. And like I was talking about before, the whole idea with the Cashmere fund is having the flywheel of compound influence, where founders through their network can compile data and insights from rising stars. Backers can bring influential backers to the fund to seek bigger visibility for the portfolio companies. Portfolio companies can share influence in sales and partnerships with other portfolio companies. And by having all these interrelated parties connect with each other and share their influence, they hopefully can leverage that growth over time. Now, it'd be like one thing if we were talking about random small companies in Nebraska or Iowa or Vermont that no one's ever heard of before, but the Cashmere Fund has some really interesting portfolio positions. Just to give you a couple examples here. One, Mr. Beast. Yeah, if you like Mr. Beast videos, you could actually own his company through the Cashmere Fund. Kind of cool. Obviously, they have merch and chocolate and candy and the YouTube channel. So, yeah, it's a portfolio company. Another, you may see these guys all over the place in social media. Graza. I cannot go to a grocery store without seeing these green bottles, the drizzle and frizzle, and all their other types of good stuff that you can buy from Graza. You can own the olive oil company. By the way, this position is 10x within the Cashmere portfolio, which is pretty cool. Another example, Hone Health. Obviously, telemedicine is an increasing place where people are looking to get healthcare coverage. Hone Health is a place where you can get men's and women's prescriptions for TRT, hot flashes, inflammation, cognition, low energy, a number of treatment items which are over time going to potentially help out people. Now, with that being said, obviously you're going to want to do your research here. The Cashmere Fund is a really early stage fund. As you can see here from the NASDAQ page, they've only been, at least publicly providing performance data since early in 2022. But since then, we've seen a pretty large increase in the price of the underlying shares. Now, something to notice here, which you may see from the chart, is that there will be periods of there being an increase in price and then it's flat or going down. This goes into how the interval fund structure works. Because an interval fund is investing in illiquid or non-traded assets, they're not being marked on a day-to-day basis like, say, the S&P 500 or the NASDAQ would be. So whenever they do mark the portfolio, meaning they try to determine the value of what they think the underlying assets are worth, they may see an increase in price. But because on a quarterly or semi-annual basis with an interval fund, shareholders can seek liquidity, they can sell their shares back into the fund typically has a pretty large portion, 5 to 25% of all assets under management in cash. And there are expenses, legal, operational, salaries, etc., that need to be paid for over time. So they will burn cash over a period of time to fund those expenses and to fund redemptions from the underlying portfolio. What I think the big picture here is over time, there's been a demonstrated performance history of the Cashmere fund to produce rates of return. It's really early stages, and typically venture capital investments can take between 5 to 10 or 20 years to materialize to fruition, where you'll see the 10, 20, 100x type of returns that people talk about in the industry. And for me, it was really interesting to see that, one, a fund like this was available, but then two, you can get into it with as little as $500, which is super cool. I'll close out by saying the Cashmere Fund is most certainly not for everybody. You definitely need to do a lot more research into this and read some of their more materials and their prospectus and the news publications. But what I would say is if you're looking for a way to further diversify your portfolio, the only free lunch in investing is diversification. And if you have stocks and bond exposures and you're already investing in a brokerage, retirement, and Roth or traditional IRA accounts, perhaps this could be a good selection or a small portion of your portfolio to have uncorrelated, diversified returns within a part of the economy which you typically couldn't get access to. I'm an investor, Sweater. I've been with them since 2022. Big fan of the work that they're doing, and I'm looking forward to seeing what happens in the future. Now, guys, if you had any questions, feel free to reach out in the comments. Be sure to like and subscribe and share with your friends and family. I'm going to make a more concerted effort to make more videos over time, but obviously, my posting schedule is erratic. I work ridiculous, crazy hours, but in the meantime, if I can do anything to help you out, just let me know. This is Rags to Riches, your certified financial planner, professional friend here on the YouTube and social media forums, and I look forward to hearing from you guys shortly. Enjoy the rest of the day, enjoy the rest of the week, and we will be in touch soon. Peace out.